us this morning?
I'll give the intro. Welcome everybody. I'll turn it over to you guys. Good morning and welcome to the Shenkman Private Client Group Accountant Attorney Winter Webinar Series. This program is entitled Strategies for Handling an IRS Audit for Business Owners. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 25 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. I always love to connect with attendees for my webinars, so if you're interested in a call or Zoom meeting or would like to share thoughts or feedback on my programs, feel free to reach out to me directly. I'll include my contact information in the follow-up email to this program. Today, we're privileged to hear from Richard Kestenbaum and Scott Kestenbaum, both partners at Kestenbaum & Mark based in Great Neck, New York. Richard began his legal career in 1974 as a lawyer for the Office of Chief Counsel, Internal Revenue Service. In 1980, he left the government for private practice and shortly thereafter formed Kestenbaum & Mark, where he represents corporations, individuals, and estates concerning sensitive domestic and foreign tax issues resulting in civil and criminal controversies with the Internal Revenue Service. Richard is a frequent lecturer on matters concerning tax controversies, including federal and state criminal tax investigations and litigation. Scott represents corporations, individuals, and estates concerning domestic and foreign tax issues resulting in civil and criminal controversies with the Internal Revenue Service, New York State, as well as other state and local tax authorities, including related litigation in state and federal courts. Scott is a member of the New York Bar, ABA, Taxation, the New York State Bar Association, and the Nassau County Bar Association. Today, Scott and Richard will be speaking on strategies for handling an IRS audit for business owners. And with that introduction, I'll now turn the program over to Scott and Richard.
Thank you, Jonathan.
Thanks. Good morning. Thank you for joining us this morning. Let me start by giving you a fun fact. Audit Lottery, only 1/3 of 1% of individual tax returns are being audited right now. So that's something to keep in mind when the tax returns are prepared, but you don't want to be in that 1/3 of 1%.
Just to show you a few of these charts here, not only are so few people being audited, but you can see over the last number of years that the IRS is auditing fewer and fewer people. So back in 2008, 9, 10, they were auditing more returns, and due to a lack of staff and lack of really compliance issues internally, as you can read in the news, having difficulty even just processing paper returns, it has greatly reduced the number of audits. So just alone in 2020, of 157 million individual returns, only 500,000 rather, 500,000 were audited, and that's quite a small number. Though I can tell you from anyone that has experience, once you're audited, it's just as uncomfortable, even if you're in that,
Well, then it goes to 100%.
Yeah.
The Commissioner of Internal Revenue has literally begged Congress to help raise some money for the Internal Revenue Service to modernize their proceedings, hire more people on the civil and criminal side. It's gotten caught up in all of the political nonsense that's going on in Congress right now. And I'm sure the war in Ukraine is not going to help things. So I don't know where that's all going, but let's talk about what exists right now. So let's talk just for a moment about the typical issues that come up in a civil audit. The first that we see often is a reasonable compensation issue. I just saw yesterday a tax court case came down again. What is reasonable compensation is a subjective standard. It depends on the taxpayer's role in the company. They use external comparisons, so how much other businesses of the same type and size are paying. They look at internal consistency within the company, how the salaries are running. Is the owner getting a ridiculously high salary compared to what everybody else is getting? And those are the people actually doing the work. The C corporation audits are looking for companies that pay excessive salaries instead of dividends. That's an obvious thing. Salaries are deductible, dividends are not. So if the salary is unreasonably high, they're going to knock it down and make it a dividend instead. S corporations have the opposite issue. They underpay salaries in order to minimize payroll tax. So depending upon the type of corporation, those issues exist on both ends of that.
So I'll just mention 2 points on that. What we commonly see is smaller business corporations, sometimes family businesses, where the father, let's just say, has worked for 35 years, but he's decided to take a very small salary, despite being the one that would really satisfy all of the items up here. His role in the company, what he's done, how he's built the business, and yet somehow he's earning $35,000 a year, and his son is earning a great deal more. And the IRS will look into that and try to sort out what's reasonable. I understand the perspective from the business owner is, let me allow my son or other family member to make more, but that doesn't necessarily jive with the IRS regulations. So just something to keep in mind. The S Corp rule is very, very common, comes up in almost every small business audit we have. So the key is to speak to the accountant that you're working with or tax preparer, and make sure that there is at least some form of comp. Now, I'll just give you a short example. Represented business, we told them multiple times over the last 3 years, you have to take some form of compensation, some form of a salary. They took none, and they were just audited for all 3 years, just on the comp issue. So just it's something that these IRS agents are trained to look for immediately once they get the audit.
Another issue that comes up often is Schedule C audits. Schedule Cs are known to have a much higher percentage of audits than other types of entities. It's much easier to audit them. The agents need less skill in taxation, and they look very carefully for personal expenses that are being run through a Schedule C, making it appear that it's a business. I've seen some crazy things. I've seen doctors in Long Island who are deducting garage spots for their child who lives in the city in Manhattan, and they have no reason themselves to travel there. They live in Long Island, they work in Long Island. So those kinds of things are very obvious to agents, and it's a common audit issue. Also, another common audit issue are loans between the shareholder and entity. Sometimes people like to take money out of the company and call it a loan on the balance sheet. There's no loan documents, there's no repayment, there's no interest being charged on either side of the transaction being recorded. Agents will not accept that any longer. There was a time when you just tell them it was a loan and it was okay, but now you need to have actual loan documents, actual interest being paid that's in a reasonable amount. It could at least be the applicable federal rate, which is a very low rate. It doesn't have to be bank interest, but it has to be something.
I'll also just mention with regard to the loan issue, this issue is critical for both taxpayers and the tax preparer or CPA, right? Because what often happens is the audit begins and the preparer starts working on it and says, don't worry, we'll put together a loan document right now, and that can pose or cause criminal issues. And we're dealing actually with a matter not all that different from that fact pattern right now. You have to be very careful. It has to be a contemporaneous loan document, meaning that it has to be set up at the time that the loan begins. There has to be legitimate payments going into the account, and you have to be able to document that. The last thing you want as a preparer is to end up with an email where you said, just here's a loan document I found on Google, just sign it and we'll send it to the auditor. And I as crazy as it sounds, this is not all that far off as to what could happen. The other common Schedule C issue, although Rich mentioned the car issue, just to give you a dramatic example, if we represented a business, a public adjuster's business, yet somehow there were 13 collector cars that were deducted on the Schedule C. So it wasn't let's just say a Ford Taurus, right? It was 3 Porsches, 2 collector Phantoms. By the time you're done and the IRS looks at those, it's very clear that they're unrelated to the business, right? So you have to, within reason, understand that those deductions are not going to work. So just a couple things to keep in mind.
Unfortunately, some audits go bad. some we anticipate are going to go bad, and some we get surprised during the audit. So what makes a criminal case? Why does a civil audit turn into a criminal audit? Well, willfulness is the magic word. The government decides whether or not the taxpayer willfully violated his known duty to pay his tax and intentionally did something, caused some act that they could point to that caused them to conclude that he was willful in not reporting his tax properly. That's the most common question. And there have been many cases where that definition that you see up there has been referred to. And here's some examples of willfulness, which are also really called badges of fraud. These are things that the IRS examining agent is taught to look for. Any pattern of behavior, things that happen over 2 or 3 years, an intended tax loss or an actual tax loss, any prior history with the Criminal Investigation Division, dealing in cash, second set of books. All of these kinds of things are going to lead to a criminal case referral. So where do these criminal cases start? How do they actually start? Well, many times fraud referrals come from the examination division during a civil audit or from the collection division during the collection of tax. There are also now some special techniques that the IRS is using. They've now started since last April, less than a year ago, an Office of Promoter Investigations, where they're looking at micro-captive insurance companies, where they're auditing now 100% of those transactions. Conservation easements, where they're auditing almost all of those transactions as well. And they are also looking at the appraisers, the accountants, and the lawyers who do those promotions. So be very cautious if you're offered one of those things for your client or for yourself. Fraud referrals also come from the scheme detection center that the IRS has. They're trying now with computers and data analytics to try to analyze things a little bit better. They call it doing more with less. Their budget keeps going down, but they keep trying to do more by using computers. They're reaching out to public and private companies to help them. They've hired some real experts in this kind of thing to teach the IRS how to use computers to help make up for the fact that they don't have the manpower.
I will just to add to that mention, with regard to cryptocurrency, specifically in New York, the IRS has opened a small office that they call it their crypto war room, where they're just focused on figuring out different ways to follow the money. I'm not sure if you saw, a number of years ago, they struck a deal with Palantir, where they are now using software, again, to go in line with the computer initiatives to just follow the money back to the wallet. So while they can't necessarily tell you who the person is at the beginning, they can sort of track their way through and follow. I mean, the intention here is, at least to help the IRS, is that there'll be some regulation down the road of cryptocurrency and other related currencies. But they are heavily investigating this. They've added it to the tax return, so now you have an obligation to answer on the tax return with regard to cryptocurrency. We'll talk a little bit later about disclosure programs. It's now become a significant part of voluntary disclosures because they are trying to get taxpayers to come forward and report old cryptocurrency that they didn't report. So they are doing all that they can. And I know in New York they are to try to collect on cryptocurrency that hasn't been reported.
We've been told that the IRS is now has the ability to break through and figure out exactly whose cyber wallet is the money being held in. So once that happens, and they can do that on a regular basis, the secrecy of cyber currency is going to be broken, and I don't know where that's headed. I mean, and now it's become a big issue now in this Ukraine thing and the sanctions, and they're trying to follow that money as well through the cyber currency. There's some other typical ways, in addition to internal ways of finding out where there might be a good criminal case, and that is informants write letters and speak to the Criminal Investigation Division. Ex-wives are a big, soon-to-be or current ex-wives are a big source of income to the IRS. Many times in a divorce action, the testimony starts and one or the other spouse starts to talk about cash businesses that one of them has, how much cash sales that they have, and the trial stops. The judge calls the lawyers in the back room and says, I just want you to know, guys, I have the obligation to turn this into the IRS. I advise you to settle, because if this kind of testimony continues, I'm going to the IRS. You don't have to worry about it. So ex-spouses are really a dangerous place. Former business partners, believe it or not. Lawsuits are scanned by the Internal Revenue Service on a regular basis. Allegations in law firms provide the basis for cases. And news articles. There is actually an employee that we are familiar with at the Internal Revenue Service whose job it is to read news articles and generate tax cases every day. So they're out there. They're out there. And of course, you know, tax protester issues, but that relatively small amount of money compared to the other things. When an audit becomes sensitive, which we refer to as an eggshell audit, meaning you have to kind of walk on eggshells when you do an audit like that, when you handle an audit of that sensitivity, the first question is, what do you do? If you know in advance that there's a problem, that any decent auditor is going to discover something, you have to reach that initial threshold question of, do I tell the auditor? Do I go into the auditor on the first day and said, look, when I was assembling these records, something didn't make sense. I started looking more closely. The client made an error. He didn't capture his bank account deposits or some other, you know, explanation. And that's many times a good thing to do. The agent appreciates it. You've done a lot of his work, but that could turn against you. They could take that, close the audit, and refer the case to the Criminal Investigation Division. I've had great success with being honest with the agents up front. I had one case where the agent took the information, it went right to the Criminal Investigation Division. They started an investigation, and fortunately were able to end it, and it came back to the auditor as a civil investigation. It's a dangerous thing to do. You have to talk, of course, very closely with the client about it, but sometimes it's the right thing to do. And many times clients are against that. They feel that they've gotten away with it this far, and they can talk their way out of it if the agent raises it. What people don't realize is the first thing the agent asks for in any examination, no matter what the computer generates as the first series of questions and document requests, is all bank accounts and brokerage accounts, because they want to check all of the deposits somehow got counted into the tax return. And if they see a discrepancy, and there's very legitimate reasons why the deposits may be greater than the income reported, could be account transfers, loans, gifts, could be many reasons why. But that's the first thing that they want to reconcile, is why the deposits don't come very close or match the gross receipts reported on a tax return. So that you have to be cautious during an audit to not just turn over things to the IRS without looking at them carefully and doing your own analysis first, so you're ready for the questions and you know how you want to handle it, and you can get some explanation from the preparer and you can get some explanations from the taxpayer, so you know what's coming next.
So just to follow through with that point, that type of issue can not only cause an IRS issue, but can also cause a state issue. So you have to be careful if you're running a business, for example, where there's sales tax, and you're reporting on your sales tax returns gross receipts of X, because you're trying to minimize your sales tax exposure, but your income tax return has a different amount of gross receipts. You know, what may start out just to flip the script as a state case can all of a sudden become a federal case, because you've now shown them very clearly that all of your returns don't match. So it's critical that you know that all gross has to match and has to be reported properly.
Remember that IRS gets third-party reporting from banks. So not turning over a bank account that the IRS is very likely to have all of the information about, but they don't tell you they have it all. They don't tell you that they have 1099 information right in front of them, and they know there's an interest-bearing account out there. And you'll be surprised. People think they're going to hide money in a bank account, but they don't want to just put it in a bank account that's a checking account. So they try to earn a little interest. IRS gets noticed. They leave that bank account off the tax return. You have to be a little bit smarter than that.
The other thing with regard to lying to the IRS, you know, not that this relates to every taxpayer, but cashing checks at check cashers has become a fairly significant issue. It was an initiative by the IRS that was pushed significantly over the last 5-10 years, going to different check cashers and getting the records. Generally speaking, just as a rule, and just using cash and checks as an example, When the IRS sits you down in an interview to ask you a question and they ask you, have you cashed checks? They generally already know the answer to the question. Okay, so they're not just asking you to see how you're going to answer and then they'll do their own research. And this goes for most questions that they're going to ask. Generally, when they're asking a question that deals with income, they've already sorted out the answer. Not an answer as to whether something should be characterized as income or not income, but whether you've reported all of your income. They have the third-party sources and they have done their at least due diligence to add up the deposits and deal with transfers between accounts. And so they know that answer. If you lie right there, you've already created a criminal issue effectively. They know that you're not honest and that there may be other issues on the return, and they're keen to try to refer it if they can. So just something to keep in mind.
Here's the script. The IRS agent comes in, and after you establish that there's been some check cashing activities, look, we have records from the check casher because they're licensed by the state banking department. They keep accurate records, photographs of anybody who cashes checks, signature cards, and they say, look, in this particular tax year, you cashed $2 million worth of checks. You reported gross revenues of $1 million. What did you do with the other million? Did you use it for payroll? Did you keep it? Did you use it for materials? What happened to the money? So half the case is over. So you have to know that is going to lead to some serious consequences. Many times those cases turn into payroll tax cases because many times, at least with contractors, that's where the money went. There are consequences to that. There was a time when in the Eastern District, at least where we're located in Long Island, Brooklyn, Queens, in those cases, the courts were pretty lenient with those cases and people generally didn't go to jail. The Internal Revenue Service, particularly the Justice Department Tax Division, has made a big stink in the Eastern District, and they are fighting very, very hard to have people sent to jail for those kinds of offenses. Those underground economy issues where people are not getting Social Security, they're not paying proper payroll tax. The IRS is trying very hard to get those people sent to jail, to give the message out that it's not something you want to continue doing. In all audits, the Internal Revenue Service is instructed to interview the taxpayer. That is a dangerous place. And they are entitled to interview the taxpayer. It's our practice to kind of push that off to the end when it's kind of too late now to do it. And all the issues have been established and we have some excuse, the guy's busy, whatever. And we try not to have them interviewed because we find that many businessmen think that they could talk their way out of anything, that they're smarter than the agent, and they'll make up some explanation. The agent already knows that explanation is not true. So I try to keep the agent away from my clients whenever possible. I don't want to be accused of obstructing the audit. That's something that you're not allowed to do, obviously. But I kind of put that on the back burner and let them get through the media issues. And then it's kind of like late already and it's time to close the audit. And I try to answer I said, tell me what questions you want answered. Let me try to reach the guy. He's in Florida right now. Let me see if I can get you some answers to the questions. So they ask some general questions. They write it in the report and you're done. So keep those interviews to a minimum because they're very dangerous. The revenue agent determines that he has reason to believe that there's some criminal action in the case and he wants to refer the case. He has to withdraw from the civil audit. And he doesn't do that by calling you and telling you that. He just stops communicating. When you can't get a call back from an agent on a civil audit that's been going on for a while, you know that there's a problem because they always call back. And they are prohibited from contacting you if they have decided that they are going to refer the case. There are constitutional issues. They can't act as a special agent any longer. They can't act as an investigatory agent. They have to walk out of the case and then follow their procedures, which is a referral procedure. They have to fill out forms. They have to go to a fraud referral person. The IRS has spent a lot of money teaching their agents how to discover these fraudulent issues. And they encourage people now more than ever to refer cases, particularly on the collection side. Used to be that people owed tax, however that liability arose, whether it arose out of an audit or some other disallowances that didn't get to audit, some automatic changes. Either way, money is owed. The Internal Revenue Service, if you don't have the ability to pay and they can't otherwise collect, you have the right to an installment plan. So you fill out a financial statement, or you want to do an offer in compromise, you fill out a financial statement. those financial statements are examined much more closely now than they were. And if the IRS determines that there are material, intentional misstatements on those, that in itself, since it's done under penalties of perjury, is an independent crime of anything else that you did. So you need to be truthful with the IRS during the collection process. You can't hide things. You can't hide assets. You can't move around assets, improperly answer the questions. It's going to lead to a one-way path of having a criminal investigation.
Two important points, and you can see in the tips here. When you're in the middle of a civil audit and you get a sense that there is some silence, you know, and you're concerned as to whether the agent may have continued asking questions after they've made the referral, which they are not allowed to do. One way to get that information, or at least sort out when they referred the case, is to do a Freedom of Information Act request. It's called a FOIA request. They take a really long time now to come, and they've taken longer because of COVID, but you know, they provide a great deal of additional information because they tell you what the agent did during the audit, what notes they made during the audit, when they determine that there may be an issue, and if it does become a criminal issue, or even if it remains a civil issue, you now have a great deal of information from the inside of the IRS. And so I would strongly advise anyone that's in the middle of either an eggshell audit or a pretty complicated issue where they think it may go criminal to request, to do a FOIA request and get that information.
One other typical criminal issue that arises in the collection of tax is what's called pyramiding, where a taxpayer either fails to withhold tax properly because he's having a cash payroll, or he withholds it and fails to pay the money to the government. He runs up a liability. Government starts chasing him. He closes the company, starts another company, same equipment, same customers, same location, runs up another liability, does that 2 or 3 times. They call that pyramid. They are instructed now to refer those cases to the Criminal Investigation Division. We picked up a case a few years ago. It was originally handled by one of these firms in Colorado that said, send us $10,000 and you'll be paying pennies on the dollar. They horsed around the government for a while. They didn't get anywhere. Taxpayer came to us. I made my first call to the collection agent who I knew. And she said, Rich, you know what we call this guy around here? We call him Fast Eddie. We call him Fast Eddie because this is the 4th time he's done this. I am referring this case to the Criminal Investigation Division. And she did, and he is serving time right now. You know, he just didn't quite understand what happened to him, but you can't do that. He wasn't a good businessman. I'm not really sure he had the intent originally to do it, but after the first time it doesn't work, and the second time it doesn't work. You can't keep folding businesses and starting again and doing the same thing from the same location with the same equipment, the same customers. It just doesn't work.
One other important point that's on this slide is dealing with misclassification of workers. So what happens now is in order to try to consolidate, the income tax auditors are also being trained on classification issues and payroll issues. Okay, so it's important if you're in the middle of an income tax case and you know that your client has, or you have a payroll issue, you can enter into a certain program called the IRS Voluntary Classification Settlement Program, where you can actually report the changes correctly. And if they haven't touched that part of the audit, then you are protected so that they can't do anything. I mean, they can suggest that there's an issue, but you can tell them you're already entered into the classification program and you've already resolved this issue. And that is a great way to save some money in the middle of an audit if there is a problem, because the penalties are quite low in that program, where they would be much higher if this issue was discovered in the audit. And there's potentially some exposure from a fraud penalty if they do discover it, and it's a great deal of money. And that's 75% of the tax. So just something to keep in mind when you're in the middle of an income tax audit.
Several times we get questions from people who are getting concerned about some things on their tax return, or questions from a professional preparer who asks us some questions that he's concerned about. And there are programs where you can go to the Internal Revenue Service before they come to you. It's called the Voluntary Disclosure. There is an established procedure both on the federal level and the state level, although they're different and cost different amounts of money and are handled differently. And you can get effectively immunity from prosecution. So you're going to end up paying the tax that you're supposed to owe. You're going to end up paying the interest on the tax. With the state, you're not going to pay any penalties. With the IRS, you'll pay some penalties, some that are fairly expensive now. But that program is very helpful because at least you can go to sleep at night. You don't have to worry about the possibility that when this gets discovered, and you feel it's going to get discovered because one of your customers got some questions asked, or you heard from the check casher that they started asking for records about your company. You can do these voluntary disclosures. We've had great success with them over a number of years. The program keeps changing. It keeps getting a little more expensive on the federal level, but it's way better than going to jail.
So a few points on that. They just updated the form, so you can look it up if you have a moment. It's form 14457. It's a great deal. It's greatly more detailed than it was before. Okay, this program, when it started, which really started with the Swiss bank issues in 08-09, has become a major program and a major source of income for the IRS. And they now have all kinds of information on penalty structures and specific types of penalties. And the one very important or two very important notes on this disclosure program, we're just coming to the end here, is one, you can enter the program even if you don't have the ability to full pay the taxes at the time. So with the state, when you get in, for example, in New York State, when you get into the program, you have to agree and sign off that you are not only going to pay the tax, but you're going to pay all the interest, and that you can have an installment plan, but that you're going to pay it in full. The IRS doesn't necessarily have that program. You can come forward and you can tell them that you have these issues. And if you really don't have the financial ability to pay, later on, you could submit an offer in compromise and try to compromise the liabilities. So it's a way to protect yourself from criminal prosecution and then also compromise the liabilities for less than what you ultimately would have owed. And this is a way to prevent an audit. You know, when you're in the middle of a disclosure in the third phase of an IRS disclosure, you have to go through the formalities of an IRS audit. But if you're coming forward in good faith, the auditor knows that you're trying to do the right thing, and he or she is a lot nicer about how they analyze, what they ask for, how many items they're testing. A lot of times they'll take the information that the accountant prepared as a good faith intention to do the right thing, and they'll just accept it. And so this is much better than getting caught in the middle of an audit. So just very important to keep in mind, the disclosure program is a great way to report an issue.
A little context on the criminal investigations. Last reporting period, there were 1,600 federal criminal investigations that took place. 60% of those cases were referred for prosecution. And of those that were prosecuted, they have a 90% conviction rate. What the government is concerned about is prosecuting a criminal tax case and losing. They don't want to lose those cases because there's a very strong deterrent effect from criminal prosecution. So cases get washed out along the way. 40% of the cases get washed out along the way of the investigation, and the rest of them, for various reasons, and the rest of them, there's a very high conviction rate. So you will see very few criminal tax trials. Most of the cases resolve themselves in a plea. So the idea is stay out of the criminal investigation division, or if you can't, use whatever opportunity you can to talk them out of prosecuting you, because once that case is referred by the Department of Justice and ends up in the United States Attorney's Office, you're going to have a major problem.
I know we're just a minute over, so just to conclude, there's a number of slides that go through the process for a referral if you want to look into that, and certainly we can answer questions on that as well. There is some information on dealing with what's called a Covell agreement between a lawyer and an accountant, which is important because as long as the flow comes through the lawyer, there's attorney-client privilege on some of the information, and that's really important when you're in the middle of a criminal case. So another thing to keep in mind. So certainly you can look through these slides, and if you have questions, you can reach out to me or to Rich, and we appreciate, John, you taking the time to let us present on this. So thank you.
Great, thank you so much. If anyone has any follow-up specific questions, follow-up questions, or business opportunities, please feel free to reach out directly to Scott, Richard, or myself where appropriate, and I'll be sure to include their contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more quick items before I let you go. First, my next program will be on Thursday, March 10th on trust and estates litigation, business law considerations. featuring Jeremy Stein, partner at Hartman Doherty, based in Hackensack, New Jersey. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you for that in advance. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.
Thank you.